Today's stream, we have a massive stream. It's a very highly anticipated day in the stock market. We're going to be getting the rate hike from the Fed here in about 30 minutes. And then after that, 30 minutes after that, so about 1 hour from now, we're going to have Powell's live press conference. He's going to get some questions, and we're going to see how the market reacts to all this stuff. And of course, in the next, half hour or so, we'll kind of set the stage to kind of explain, or at least look at a bunch of stuff to make sure, we're at least somewhat prepared. I think this is a very, highly anticipated, I think we know it's a very highly anticipated day, especially given how we've seen the market react. If you were to go back to the last CPI report here, we're looking at the S&P 500 ETF right now, SPY. Leading up to that last CPI, the market pushed up to about 414, 415. SPY did, off of the 390 lows that it hit back here. September 6th, it was actually the day that it pulled down just below that 390 area on the 6th, believe it or not. And then goes on a massive run on the 7th, 8th, 9th, which was a Friday, and then the 12th, which was a Monday, and then into that pre-market session on the 13th, which was when we got that CPI report. We were looking pretty good. We're up about 1%, and then boom, the hammer was dropped, and we've just been, obviously trending down since. But we can, obviously look at this chart and say to ourselves, what are we seeing right now? The past couple of days, so, this week really, has been kind of just, or at least from Friday into this week, has been kind of just trying to shopping around. We did look, we made a new low, compared to past couple of days yesterday, but then quickly bounced right back into the close and, finished the day, not green, but finished the day at least relatively strong. So we've been in this just little chop, and I'm not surprised, right? We kind of thought this is something that's very possible that we could see happen because, everyone's waiting on the next catalyst. Today's, rate hike, today's meeting results, right, from the Fed. And once we get that, obviously the market should have its next short-term reason to move. And again, when we say short-term reason to move, though, I want to make it very, very clear that the short term obviously can be, volatile based on what's going on, SPY and all that good stuff, and news and everything. But the reality is the market's, forward looking. So a lot of things get priced in ahead of time. And so I think that what's concerning is that in terms of getting priced in ahead of time, I think a lot of people already positioned inputs. We'll see if that continues or that gets, more aggressive this week after this meeting. Does that mean that we have to go up? No. Does it mean that the puts can win? Yeah, they could totally win this week. You know what I mean? So we'll, or just today, and then we can get a snapback reaction tomorrow. So that's the ultimate question, is that given where we're sitting at on the put call ratios, all that stuff, I'll pull up a put call ratio here for today. It's relatively high. It's around 1 for today. We hit the highest level on the put call ratio back on the 16th. That was around 1.6. That's the highest we've seen since April of 2020, which again, April of 2020, we've talked about was an amazing time to buy stocks, in hindsight, looking back. So that was something to note, and if you go back even further, put call ratios have spiked up substantially, right, back in late 08, 09, and that was also a really good time looking back, in hindsight to buy stocks. We shall see, what happens going forward, but this has been elevated. And if we look at the bigger picture on this chart, what you'll see is yes, we've had spikes. It's come down off of that spike. But again, that just tells you that people have already acted upon that. But what's, notable and what's more important, I think, on this put call ratio is that, yes, even though, yes, we've kind of been trending to the upside in terms of these higher highs and these spikes over this past year, right? Ever since the Fed started to tighten, policy started to tighten and all that stuff, rates started to rise. Yes, we know. But it's also notable here too that, you've seen substantially, higher lows, or at least that trend is pretty notable on that put call ratio. So it's pretty, especially as of late, the past couple of months, that's even more notable really since August. It really kind of, that trend line is pretty steep. We can obviously snap back down below that. We'll see. But, those higher lows, again, are just, what it's telling us is that it's not something that's been happening or it just spiked or whatever. It was kind of not anticipated. It was highly anticipated because we've seen higher lows in the put call ratio over the past, past year, really the past year. We've been seeing that and higher highs. So it's, again, we've been talking about it's somewhat anticipated, but does that mean that it has to be wrong? No, it doesn't have to be wrong. So that's where it kind of gets, I think that's what's been confusing a lot of people, who like to look at sentiment and who like to look at things like the put call ratios. Although, albeit, right, the put call ratio this year alone, this is a 5-day moving average here on CNN Business's, Fear and Greed Index. if you go back to the spikes this year on the put call ratio, mid-May, mid-June, even go out through July, we had these spikes. Those were, really good times to buy. And this, these troughs were really good times to sell, so it has been working in that favor. And obviously, the past couple of weeks, past like month, we're definitely making a push to the upside. And so is the top in, is the peak in on this little push? We shall see. If that's the case, there should be a decent little rally, on the S&P if that's the case. And this correlation continues to work this year, but there's obviously no guarantees. So that's kind of setting the stage a bit as we get ready for this rate hike and the Fed to come on and all that good stuff. But hope you guys are doing good. And to be honest, I think what's very possible, and you kind of have these not weird thoughts, but these thoughts. I'm like, I could easily just see that it ends up being a nothing burger in a sense, and a lot of people who are in calls, puts, whatever, are just going to get burnt because their options are going to expire worthless. So there's the premiums are pretty high on terms of what they need to, what kind of move they need to see to get in the money, or if that options to actually hold value. And you're going to see some theta decay, you're going to see some volatility decay. There's going to be a couple things at play here. So if you're not on the right side of a substantial move, it could be pretty nasty. And even if you are on the right side of a move, if it's not substantial enough, it might not be as big of a play as you think. So, a lot of ways to play it. I think selling options this past week or even last week, if you're selling puts, selling calls, it probably was not a bad time to do so because you probably got, especially on the put side, more so on the put side, you probably got some decent premiums. Now, could those options end up expiring in the money if we do get a big move to the downside? Oh yeah, 100%. But doing it selectively on stocks that you wanted to buy or companies you would like to hold anyway for the long term, maybe wouldn't have been a bad idea. That would have been a decent way to hedge yourself or at least profit up potentially. If we went to the upside, if we never got down to those strikes that you were selling puts at, you could profit that way. So it's, these types of weeks, these types of events are good for certain situations, for certain strategies, and maybe not so good for other strategies. So we shall see. We shall see. Hope everyone is doing well, and we're getting started a little early, but we got some big stuff coming here. About 25 minutes until the rate hike, which I think is pretty much coming in. It's most likely going to be, a 75 basis point hike. Here's the current chart. 75 basis point hike, 84% chance of that. And then a 16% chance of 100. Now, I want to mention this too, because I'm kind of curious what everyone's thoughts are, on this as well. But in terms of this rate hike, let's just say that they did a 100 basis point hike. I'm actually kind of curious as to what the reaction would be, because I don't know if it would necessarily be the market, at least in the short term, would react in a bad way. I'm kind of thinking that maybe if that happens, everyone who sees the headlines, algos that might see the headlines, immediately short, immediately sell, whatever, hit puts, slap puts, and then if maybe that dip holds, or that's the first reaction off the initial, seeing the first reaction tends to be the wrong reaction. And then you have about 30 minutes or so to see where the market heads. And then we tend to see a reversal into the first few minutes of when Powell speaks. That's just been the trajectory, right? Do I care which way? I mean, I don't know. We'll see what happens. But it's maybe possible that if they do 100, you get a quick reaction to the downside early. Everyone thinks, oh my gosh, 100, it's terrible. It's so bad. And then all of a sudden we kind of rally into Powell's speech. It's possible. Only reason why I'm thinking that, because maybe in a weird way, that's seen as a good thing, because then, hey, they're getting closer to the end of the hikes, or that might be like, hey, like we're going to just continue to front run this, which means that next year there's not much to do. Maybe that's a thought process, based off CPI into next year, right? I don't know. Market could take that a bunch of different ways. So all the reasons for that to be bad, right? There's a ton of reasons for that to be bad. But then, getting to that end point maybe becomes a little bit closer if they do a 100 basis point hike. So I was just thinking that through and thinking like it might not be as obvious of a downside trade as you think. But we'll see. We'll see. Have some quite aggressive longs in place, affirm shares and calls, some TQ. You're setting up for, make or break almost, right? But yeah, this is I'll look at the put call ratio again. Back to this thing, it's kind of pushing up a little bit here. We're kind of seeing right now today, at least, it's pushing back up. It's up over 1. Is that a massive deal? No, 0.7 is average though. Just big picture, upon past couple of years or just in the market in general, 0.7 is average. So obviously we're trading above average today. We're down not nearly where we were. But where everyone was buying on, was that on Monday? On Friday. Friday, everyone was panicking and buying puts on Friday morning. And then that's kind of transitioned, or at least that came down. That ratio came down a bit. A little more calls were bought later on in the day, but a lot of puts were bought, at the open right away on Friday. And we're kind of seeing, generally speaking, some more puts being bought here this afternoon, this morning, as the market's gone up, which kind of makes some sense as we've kind of seen the market go up. People are buying a little bit of puts, and I think it's more so hedge positioning. This Friday put call ratio that spiked up was more so panicking. I mean, if you go back to Friday, let's go kind of look at where the market was on Friday. I'll go back to SPY on the 5-minute chart here. So what was that? So what was that on, what was the date again on that thing? The 16th, the morning of the 16th is when that thing spiked up. If I go back to the 16th, yeah, that's because, again, what happened here on the 15th into the 16th, we had a pretty big gap down. Market moved down from the day prior substantially, and then we ended up, down here, well below that 390 on SPY, and everyone saw, hey, if 390 breaks on SPY, it's going to be bad. And so what did everyone do is they bought puts, or at least, the put call ratio tells us a lot of puts were bought that morning. Now you broaden this chart out and you say to yourself, okay, well, if you bought puts that morning on the 16th, what's happened since? Well, we're actually, first off, we're higher. So, there have been times, yesterday afternoon, there was a period we were lower, right? But we're actually higher right now. So far, those who bought puts at that time are, if they haven't sold, they are bagged right now. And so we'll see if that continues to hold true. But, these types of indicators, or these types of, it's good to kind of look at in terms of where the chasers are at, and you can kind of clearly can see, why. And it makes sense. You broke down below a pretty key spot. And so instead of buying puts the day before, as we're sitting on that support, which, was kind of a scary spot, like, hey, we can bounce, we can not bounce, are we going to break through? What's going to happen? I don't want to hold overnight. Everyone saw the breakdown overnight, and then they bought puts that next day. And of course, the move down was, like a $7 gap down or a $7 gap down. And, a lot of that move was already taken care of. So if you had bought puts the day before and then sold that next day, you've made a nice chunk of change. So it's not as easy, right? It's not as easy as the masses always, as you may think, right? Or based on psychology and based on what people's thought process, you're kind of seeing how that played out late last week. Butts to hedge cash positions, setting up for October. I mean, we'll see. We will see. But here's the daily chart on SPY. So you broke down below. We never actually got that spot that I was months ago about it in July. I was like, I kind of would like us to see if we can pull back into this. I was back in here. I remember saying it. If we can pull back into this spot, we never did. And then we might have gotten it now, but obviously it hasn't happened yet. Got close. 381, 35 has been the spot on SPY this past week, or I was yesterday roughly 381.30, but couldn't break down to sub 380 to fill that gap. It was an overnight gap from mid-July. Not that it needs to fill, but something to think about. Swinging position options, it depends. I mean, it depends on I think it really comes down to it's the same concepts as I have learned a lot about it over the past, X number of months. More specifically, done it in the past. I did it, years ago. Then I got into small caps. Obviously, small caps have been what they've been the past, year. And so you get into a bunch of different things. If you're going to do that, you have to respect your risk, but you kind of have to, you got to use daily candles, I think. So using the daily chart, saying, hey, if we have a daily close below my key level, or if we have 2 daily closes in a row below my key level or below my support or above my resistance, I'm going to stop out of the trade. So that's kind of how you would go about it. But in order to do that, without having that move that you would get for that stop out become too massive, because sometimes you can break down below levels and, you can get a big move down, then it can snap back up. And so if you want to be able to actually have, let the day close, let the 1-day candlestick close below your level to tell you to stop out, then you want to have time. You want to be buying time. So the best, I would say, advice would be to buy as much time as you can and buy in as close to at the money or in the money as possible if you want the lowest risk. If you're not going to do that, you have to accept the substantial risk, right? There's substantially more risk in buying farther out of the money options and buying shorter expirations. They're more expensive, but that's what you have to do. So what I would recommend is looking at the 3X ETFs, because a lot of the 3X ETFs, like if you look at the 3X ETFs on QQQ, the TQs, SQs, or SPY's 3X, SPXL, SPXS, those 3X ETFs are so much cheaper in terms of the actual price they trade. There's still a 3X ETF. There's still some decay there, right? You have to understand that, but they're much cheaper. So the option premiums are just by default going to be cheaper to buy in the monies or to buy at the monies So you can go out further in time, and it's not going to be as expensive as buying a SPY contract in terms of dollars out of your account than buying a SPY contract for the same time. So you want to go out to like January right now. I would say that's probably a pretty good time frame, right, for swings. Let's say you were swinging something and you're like, hey, if we hold here on SPY, like what I'm doing right now is IWM. I have an IWM swing, right, that I'm saying, hey, if we hold this 175 and we, don't have a daily close below that level, I'm going to stay in my positions. And I bought some January calls, but I bought TNA, which is a 3X bull ETF, and I bought a couple of them so I can scale in, scale out, rather than just being able to buy like one or two, IWM contracts for the amount of money that I'm willing to risk, right, in that scenario. So that's the best way I would put it. Buying as much time as possible. You're still going to be able to get decent moves, even if you buy a lot of time, right? You're not going to have if you get a massive move tomorrow or today, you're not going to make as much money, yes, as if you bought, a January contract, right? Compared to buying, this week's contract, but the risk is, substantially different. So it really comes down to your risk tolerance at the end of the day, when trying to do something like that or trying to swing options. So you got to be careful. I've, made plenty of mistakes, still make them, right? But it's the best advice I can give, I would say. Theta on the ones with a lot of time, a lot better. Yeah, 2 months out. Yes. Give her. Yeah. That's a good idea. Had an Apple call for October 7th. Bought it was 154. Was down 50%. Now they recovered 50%. 12. Oh, that's nice. Up 20%. Another semiconductor bill in the works right now. Oh, that's interesting. Expecting an earnings run up this quarter won't be nearly as good as last. Yeah, I would expect this next earnings cycle to be pretty nasty. I can't imagine it being good. But again, I don't know how again, reactions are going to be stock wise. You kind of saw how last earnings cycle, if you go back to like Apple's and Amazon's, let me go back to some of those charts. Let's go to Apple's chart. Apple's last earnings back in August. It's August 5th, so we're only like 1 month or so out of, or no, it was back in July 28th. Did surprisingly well, gapped up after that, and had a nice little extension push into that high for August. So I think that, I don't know how much was priced in, but it seemed like the reactions based off last earnings cycle weren't as bad as I think we were kind of maybe expecting. The May cycle, the April-May was pretty scary, and market was selling off into that. But I think the last one was, I guess, maybe a lot was priced in. I don't know, but I can't imagine they're going to be good. And I think that the real danger is probably going to be next year across a lot of these companies. I don't know how bad it might be this year, but I think you're going to really start to see that next year, especially if these hikes continue, and the market, and we don't get to a point where we can see the end in sight. If that doesn't happen, then yeah, yeah. You can see how like next year you have a bad earnings, and then it's like, well, we are still, rates are staying high and there's no end in sight or there's not really a clear vision as to when they're going to come down again. You're going to probably see some nasty, guidance numbers and earnings and stuff. But, then again, right? Who knows how much that is, ultimately going to get priced in ahead of time and whatnot. But yeah, bigger picture, like I've kind of been feeling, I really don't know I don't know if I'm a really massive fan of stocks into late next year, like second half of next year. We'll see. But, as we get into next year, I would ideally like to see some rallies so that there's some opportunity to trim or to take profits on some stuff. But we'll see if we get that. We'll see. Want to be long for October? Yeah, you know what? CCL has earnings tomorrow. I'm not expecting much out of that. I still have the position in the covered call portfolio, but I think I'm up a decent amount. It's down under $10, right? Yeah, the chart's not too bad. This thing was down like 5% today. It's been building these higher lows. Chart's still there for now until, we'll see what happens earnings-wise and stuff, but chart's not terrible on CCL. Puts the move for today. I don't think, my if I had to give you a gut thought, no. But then again, I'm not going to guess. I'm not interested in guessing, because the thing is, you have a lot of people who've already been buying puts past like week or so. After CPI, it's been the opportunity to buy as many puts as to buy puts and to be positioned for this. So does it mean that we have to go up? No, and do the opposite? No, we don't have to. But I would also be concerned with the decay on some of these options as well, because you have such a highly anticipated event. if it doesn't live up to the volatility expectations at all, or if we see a really big volatility collapse this afternoon or even into tomorrow, right, you're going to have a lot of premiums get killed. So I don't know. I would be very cautious, but I think that what's more important to see is what Powell's going to say. So we'll have Powell live in about 40 minutes or so until Powell comes on. So we'll see what he's going to say. Let's look at SPY's chart right now, 5 minutes. I mean, this is a kind of a classic setup right now. We're seeing, we're just indecision, right? Support right here, resistance up here on SPY. No one really wants to trade out of that range for now. So you're ranging from like 385.50 up to about 387 on the high end. And so I would imagine that the catalyst will be one of those catalysts to break that will be coming very, very shortly here in about 10 minutes. So you think I'll be like, no, I don't know. I don't care necessarily to guess what's going to happen today. If someone said like, hey, like if someone put a gun to my head and said, hey, you have to pick SPY calls or puts, I'd buy SPY calls for Friday just because of how many people are positioned in puts, and the move potentially of last week, setting us up for, that gave us a decent chunk of downside already. But, it's anyone's guess, right? In these events, anyone's guess. And then at the end of the day, that the reactions can be completely random too. And they're not going to make sense. And everyone's going to try to put some sense behind it too. But a lot of the times, the sense that gets put behind it is just noise. It really is. CNBC is going to always try to have a reason. Oh, well, you know what? The market's thinking this is anyone's guess. Okay. 10-year, 350 or 3.57-ish, 3.567 right now is the 10-year yield. This is also something I'm really interested to see what happens today. Hit 3.6, is that yesterday? On the 10-year at 3.6 yesterday. Just actually 3.604 was the high yesterday. And kind of crazy move. It's been this, channel. It's not a perfect channel, but I just kind of drew this channel in so you can kind of see the rough idea or the rough trend line that we've been kind of holding on to. On the 10-year, got to the top end of that channel roughly yesterday on that 3.6 touch, and then we kind of pulled back a little bit. Now we're popped back up, not as high today. And I'm curious how much this is going to move. I actually wouldn't have been surprised if the Fed came, well, it depends on what Powell's going to say, but if the Fed came out here and did a 100 basis point hike, which I don't think is going to happen, but if they did, I actually wouldn't be surprised if we see a quick spike up in the 10-year and then a slow kind of, or not necessarily slow, then just a give back of that move into the end of the week and maybe even come lower than that 3.5 by Friday. I just think that would be more of a signal that, hey, they're going to really front run this and that we're going to be done sooner rather than later. That's kind of the way I would potentially see that. So we'll see. But obviously, this has been pressure on stocks, obviously. So, you need to see bonds reverse if you want growth. I will say, if looking at this from a broader scope, from how the 10-year has done, how the 2-year, the 30-year, go look at any yield, right, curve that you're looking at right now. They're up extremely high, and if not at highs on the year, whereas the market's actually holding up better than I would have thought. I would have thought we'd be seeing a lot more downside right now, given how rates and yields have pushed. So I'm kind of curious to see if one of the other is going to give, right, soon. And that means maybe the 10 years going to come back and then the market starts to kind of, slowly kind of curl up, or the 10-year stays high, doesn't have to keep going higher. The 10-year just stays high and the market really kind of flushes through and drops under 380 next. That's the question, because the correlations have been pretty good. Up until as of late, it's kind of been the market's kind of holding better than I would have expected given the moves we've seen in yields. So we'll see. But again, there's always an ever-changing environment, and the correlations are never always going to stay the same, for forever, right? CCL earnings on 9/29, not tomorrow. Okay. Our move in the last decade has been insane. Need to keep that in mind. Oh yeah, 100. I think that's something that people don't realize and are not thinking about either. The market's doing the same as you're thinking. You want to see something before you jump into buying seriously. That's exactly why it'll keep dropping. I mean, I don't know. I don't know. The only thing that I say, I think people have to just take a step back and think about too is when they get a little too confident in their thesis or their rationale, because no one, I mean, realistically, that's and I've made the mistakes myself too, and it's lost a lot of money. When you think that this is going to happen, oh no, it'll happen later on. Then it'll happen. You're asking for trouble. So Who knows? Who knows? Seriously, in my view, this past week, right, it makes no sense to try to guess today's action, right? See what happens, and then go from there. 395, 393 incoming. Where are we at now? So that's the upside of that move. That would be up to that trend line, right? So if we got that on SPY, here's SPY, right? If we got that 393 or 395, that would be up into here. So that would be like right to that trend line. So that would be funny. And then that would be the key spot I think is 401. 401, you get back above 401, and then you're talking about, maybe a shot to 410 on SPY, this volume node right there. So, that's so far away. Maybe it won't be far away by the end of this week. Who knows? It depends on how this reacts. But that's going to be kind of the line in the sand for me. Yeah, the trend line and all that stuff, sure. But I think that 400 area is going to be your spot as, we get above that and we hold above that for a couple days. You'll just see how fast the sentiment's going to change. Is that a good thing or a bad thing? I don't, we'll see. But you'll see how fast, CNBC, you'll see how fast the networks, and you'll see how fast everyone's, mindset changes, and if people are buying calls again, so that'll, and I'm sure you'll see it in the put call ratios kind of resetting, come back down. That's going to be the spot, the line in the sand, at least to me. From a price action standpoint, if you get that price action movement over there, we'll see. Steady till tomorrow. Friday will be dropped. We've seen those situations too, where we've had the meeting come out, right? Whatever reaction you get, and then the next day it just gives it all back, or it goes the complete other way. So we shall see. So the rate decision is coming in like a few minutes. I'm gonna pull this up really quick. Let me get some. Make sure we have it, and then we'll have Powell live in about, I don't know, what is that going to be, like 30 minutes from now, 35 minutes. We will see what Powell wants to say. 35 minutes. So what is it? It's about 1 o'clock Central Time for me, and it's going to be about 2 o'clock Eastern Time here when we get the rate hike decision. So that rate hike decision is coming out. They're expecting a 75 essentially, and it's probability-wise, we're at 84% chance as of last check. I'm assuming it's going to be the same number. 84% chance of a 75 is where it's at. The other thing to think about too, that I guess in general, look out, we're 3 minutes till the countdown, right? 84%. Another thing to think about too is this environment has been, for a lot of us too, I think that we've been seeing, and we try to keep it pretty laid back here at the end of the day, but you see a lot of people who are like set in their ways, and they're getting pretty angry, man. They're getting pretty aggressive, whether you're long or whether you're short. Because if you're long, right, depending on what you're long, you're hurting. If you're short, right, and you're shorting at peak fear times, or you're shorting into, you're chasing shorts, right? We just went back to that put call ratio that spiked up on the morning of the 16th. Is the highest put call ratio we have seen since, I don't know, April 2020. But what was that? That was after we broke down below 390 and had a pretty big gap down of like $5 to $7. That's when everyone bought puts. So you can see the pain on both sides. I get it, right? There's pain both ways if you're trying to chase, moves. So that's been I guess that's probably been part of why everyone's up, in arms. 395, 393 is the weekly pivot. We move above that with confirmation. Bulls having our little run. I do expect ABC move up. Best thing to trade for today. Well, let's see what happens after this rate hike in the next 3 minutes, and then we're going to get a better feel for where the market's going to head. The thing that's been interesting too is Nvidia has been up a lot today. It's up 3%. Just a couple of different stocks to look at. It's had a nice little move off the lows from last week. Apple has been notably strong. Tesla's up there. Tesla's up out of resistance right now, and it's kind of just like, if Tesla can hold above 305, oh man, this looks pretty juicy. So like Tesla's just got that look of like, hey, if this can hold up, it wants to. It's got some higher lows building it. It wants to go, and I'll show you the daily chart on Tesla. And it'll happen probably pretty fast if this move after today is positive. Tesla could be at like 325, 330 right here. Very, very fast. Very, very fast. And you're up at resistance right now. So do you want to front run it? And again, in hindsight, you're going to have people who look back and say, yeah, you didn't see that breakout. It was obvious. Well, yeah, if if you wanted to hold through a Fed meeting and Powell's speech, yeah, sure, it was obvious, but did you want to hold through that? Like maybe that wasn't so obvious, right? So maybe honestly, in some of these, it's just shares is the better way to play it if you want to be able to be a little more nimble in the after hours or pre-market hours in case stuff starts going against you. Options, you're kind of limiting yourself to just during the day or during the trading hours, the regular hours, to be able to get to be able to run that. All right, so we're gonna get this rate hike decision in like 2 seconds, it seems like, and then we got 30 minutes to go until Powell's speech. We've kind of seen is generally speaking, we'll get a pretty big move. We should get a SPY reaction here. It should be a decent up or down, and then whatever happens after that. Leading up into Powell's speech, generally speaking, we kind of see more continuation about 5 minutes into his speech, 5-10 minutes into his speech. That's when the market tends to pick a direction and start to move and go with it. So we'll see. All right, looks like we're popping a little bit. SPY's up towards high of the day. I haven't seen it come through just yet, but it should be coming through any minute or any second here. SPY is up high of the day. Now it's come back. It's coming down. It's going up. It's going to be jumping around. Now we're going low of the day, dumping. See how that candle goes? They hike by 75. So the Fed hikes by 75 basis points. Here, I'll just refresh this so you guys can see. So we got a 75 basis point hike, kind of in line or right in line with expectations. They hiked to 75 or hiked by 75 to a 3.25 versus a 2.5 previous. And the estimate was 3.25. So expectations were met here so far on SPY. Now we are flat. Now we're going red. So we're dumping off that move. Initially, it kind of popped a high of the day. Now it's dumping. So the question is going to be 12-0 was the vote in terms of voting for that decision on rate hikes. We're not down to yesterday's lows. Yesterday's lows are 381 on SPY. If this plays out the same way that we've kind of seen potentially this has played out in the past, you get a big move down, and then you get that, Powell starts talking and it's kind of bounced back up, and we've had decent days after the rate hikes. Let's see if that is the same situation. We're only a minute in and we're down about 0.4%. So that's a massive move. That's a massive candle down. I might go to the 15-minute chart so you guys can kind of get a better view of that candlestick. That's a pretty big move down. We're down now we're getting very close to the lows of yesterday. But technically this is maybe a support spot too if you're looking for a bounce. But then again, your volatility is nuts right now, so I don't know if I would be you gotta be quick. You'd be scalping if you're looking to take something like this. You're down towards yesterday's lows, not down to them yet, close to them though on that 15. That's a big move down, right? In a 1 minute or it's been only about a minute or 2 minutes now. So from high to where we went low, dropped about 1.3% from high of the day to that low in a minute and a half, not even. And now it's back. So you see how, imagine snagging, imagine if you're someone who's looking to scalp. I'm not interested in doing that. Imagine scalping and buying some calls down here versus or around lows here, looking to play versus low of yesterday. And if you snag that quick, you're already up immediately. Just now you're up, quickly. SPY, is up like $2-3 or no, $2 from the low already. TPM, SPY up and then down. They expect 4.6 by end of 2023. Yeah, we can get into some of that stuff here too, and I'm sure Powell will reiterate expectations and what he thinks. But yeah, let's look at some of the stuff that's coming through. We can go into the article and get into it in more depth in a minute too. We got 30 minutes until Powell comes on, and we'll kind of see. 10 years up to 3.64 after meeting statement highest since 2011. That was higher than yesterday. They see inflation at 5.4% end of this year, 2.8 the next year, and 2.3 for 2024, 2.0 by 2025. Fed official see funds rate at a median of 4.4 end of 2022 is what they're saying now. So SPY is taking a little dump at least off of the highs. It's only down 0.25% for compared to yesterday. Straight down, did not trade. Won't start cutting until 2024. Is what they're saying now. Volatility index pops up on that too. US2. Let's look at yields. Let's look at the yields. 10 year. It popped and then it popped to 3.64. Now it's back to 3.6, coming down. So I'm curious to see these reactions and the follow through right on these moves. If SPY follows through to the downside, if it does, that would be pretty notable too because we haven't had that. Like if Powell comes on in 30 minutes and we get a continuation to the downside and we have a pretty big nasty day, and we really kind of not plummet, but just kind of fall, the floor drops out from underneath and we keep going lower and it continues and confirms lower. We haven't had that. That hasn't been. We've had these reactions where the initial reaction is the wrong reaction, then we get the reversal. So 10-year spikes. Like look at a 5-minute chart on the 10-year. Look at that move on the 10-year. Spikes 3.64. Now it's back to sub 3.6. It's bouncing around. It's going to be volatile. I'm not expecting it to not be volatile. The DXY is up. I think DXY hit a new high here. This is the dollar index. Yep, it just hit a new high on the year there on DXY. Yeah, man. I mean, this is another one of those. Well, for now, we're getting some pretty big reactions. In some insane scalps. Yeah. No, yeah. If you're quick on these moves, yeah, you can be. But now look, we're at those lows. So we're at yesterday's lows. So if you're now we're breaking below yesterday's lows. So if you're looking for a bounce, right, you would hope to see yesterday's lows hold roughly, but you can't. It's tough because you can't give it like you think. Oh, let's give it a 5-minute close. A 5-minute close, man, you're gonna be so late. There's so much can happen in a 5-minute span. 2-year, 10-year yield inversion deepens to 50 BPS on the 2-year, 10-year yield curve inversion. So that's a pretty big move down there on SPY. Now it's down 0.9, down about 1% on the day. QQQ down 1.3% on the day. IWM down 0.7. These were all green, right? They were all green about 5 minutes ago, and substantially green. They were about 5 minutes ago. Tesla, like we were just saying, right? That breakout was setting up. If it can hold 305, well, boom, it just blasted right below that 305 in like 2 seconds. So there goes Tesla down below that. So that doesn't, unless it's the fake out, right? Unless it's the fake out, it doesn't look like that breakout's going to happen here on Tesla. For now. NVIDIA is still holding on to the green. It was up a lot more though, I guess. Still holding on to the green. Still above this morning's lows, actually, believe it or not, on NVIDIA. But SPY just hit a new low and then bounced. So it broke a new low of the week. It broke below yesterday's low, and then it just snapped back up from that. What was that? From like 380.25 up to 380, almost 382. So the $1.50 move in like, a minute. Raised rates by 75 basis points. Now at the highest point since 2008. See inflation at 5.4, end of 2022, 2.8 in 2023. So they expect more rate hikes into next year. DXY, pronounced Dixie. Support lines don't exist. I've said it before. No, yeah, when you have events like this, it doesn't matter. And all that support and resistance is, it's you thinking that it's a higher probability of X happening over Y. It's not. They don't have. Again, nothing has to hold. Nothing has to happen. Nothing has to hold. Nothing. The best setup in the world could look so perfect. Could be like, oh my gosh, this is like a 9 out of 10 or 9 times out of 10. This happens. I've seen it happen all the time, and it could not. Right? Nothing is guaranteed. Short Tesla and QQQ from 310. Where's Qs? Qs just broke below the week lows and it's now trying to hold. So we'll see. I think that the next 20 minutes or so we're gonna have. Well, I'm not sure what we're gonna have, and I think Powell's speech once he starts talking will be the continuation move. That will be the continuation move. Either we're going to get that follow through to the downside, or we're having, fake out central and we're going to just be, snap back up, and who knows. 10-year popped, then it dropped, then it popped, or then it's back up a little bit again, 3.61. So the 10 year's back to higher than where it's been. Let's see. What else is going on here? So that's that. We got that to look at. I want to pull up a couple other things too. In the meantime, I'm curious how this put call ratio is going to shake out as well. Let's see. Popped up a little bit. Now you kind of see it coming down. So I guess since that, past 15 minutes or so, past few minutes or so, it's been actually coming down a bit, meaning more calls being bought actually. But we'll see if that how that trend continues into Powell's speech and where that shakes out post Powell. NASDAQ down 0.7, S&P down 0.5, Dow is down. What is the Dow? The Dow. Yeah, Dow's down 0.5. NASDAQ 0.75. Oh, it's not like terrible for now. I'm sure Powell will have a say in that though. TLT fell off a little bit. Of course, the yield's popping back up. Small caps, IWM is down 0.45. XBI down 2. ARC is only down 1.25. right now. ARK didn't fall below 40 yet on ARK. Just kind of looking at some of these guys, honestly hasn't had as big of a move as I would have expected on ARK. But yeah, now look at that. So bounce from 381 or sub 381 on SPY, now back to almost 384. So it's like almost a $3-4 bounce here in the past 3 minutes. So I mean, you again, like people asking like, oh, what's the move? What's the trade? Like, I mean, if you're gonna scalp, go ahead and scalp, but be quick, But do you want to mess with this right now? I don't know if I really care to mess with this right now. I have no interest. Let it shake out. All right, let's see. Support lines exist to see where stops are. Exactly, that's true. Well, you'll see that I saw it happen. You see it happen all the time. But I was seeing past couple of days. We've been seeing at least some of these moves have been like right below support and then a bounce back up. It's not like we're going higher. It's not like we're going higher and it's like we're still net going lower. But you're seeing breaks below support and then snaps through and back to the upside. Euro extends losses versus dollar, hits a fresh 2-decade low. 5-year yield inversions extends to minus 28 BPS, deepest since 2000. Oh man, it's like all this stuff comes in flying in, right? And it's like everyone tries to unpack it, and you get these crazy reactions, and then you'll get some smoothing of this, hopefully, into the end of the day, whether it's up or down. Fed swaps indicate terminal rate of more than 4.6 this cycle. 5-year yield rise to 3.86, highest in 2007. Fed futures after FOMC implied to see an 89% chance of them raising another 75 at the November meeting. That's what we're seeing. And I'm sure we're going to get some explanation from Mr. Powell here in the next, in 20 minutes from now. We got that. Let's see if I can pull it up. Yeah, check. I'm going to just double check. Check the audio on this. See if it sounds. See how it sounds. Let me know if it sounds. There should be audio on this. Yeah. Let me know if that was too loud, not loud enough. I can adjust some stuff here. So we'll have, once Powell comes on, we'll have that, and we'll have him talk in the background and see how the market at least reacts to any of that, to his commentary. Starting Starbucks calls. Yeah, no, I think that was the case in terms of the 75 basis points pricing the forecast was not. Yeah, but then again, also to some degree, I don't know how much I don't know, maybe the market wasn't, but were we necessarily expecting the forecast to be like a positive forecast? Like, oh, we're not going to cut as we're not going to rate hike as much as we, maybe no. After that CPI, like, yeah, why? There's something in front of them right now in terms of the Fed that's telling them to slow down or to to stop. So based on what they have in front of them, yeah. And then the danger is going to be, or if you're looking for the backside of rates or yields, or if you're looking for like things to get really bad, the danger is going to be that if CPI comes down into next year, like aggressively, because of the front run of rate hikes, and it wasn't a slow easing, it was kind of like an aggressive ease. A slow hiking, right? A slow tightening. It was kind of an aggressive tightening. If that ends up, doing a lot more harm than good, it's going to be the damage is done, right? So there's nothing you can do next year necessarily. You can cut all you want, but the damage may already be done next year, right? On that front. So that's the question, and that's where we're going to be. So we're going to try to figure out, right, in the next 6 months or so. I think that's where everyone will be looking. Plan is now just let the portfolio rot a little. Everyone tries to convince they're going to cut sooner rather than later. I feel like that's been kind of the case, but who knows, right? Everyone on the both side is like, well, what if they cut earlier, right? You could say what if, you can say this or that, but the Fed is not going to make that determination really until either the job market is looking horrible or CPI is telling them to. That's just what it is. So as much as like everyone kind of gets freaked out about these events, I mean, the events really is going to be the CPIs, and as the last CPI, I guess we saw a massive reaction there. I guess it makes sense now. So, but in about 15 minutes or so, we'll have Powell live. Look at that volatility. So I'll go to like the 1 minute chart so you can see how volatile it's been. You tipped into this little purple box, which was our gap to fill I was looking for. So we kind of started to get into there. Maybe we'll get that today. That's back from July. But you had a massive move down, right? Of the initial reaction, the initial move down was 1.8% from top to bottom in about like a 5-minute span. And then you bounced from there. You bounced back up on SPY, up about 0.8%. And now you're back down about 0.5 from that bounce. So those are some freaking massive moves. I mean, you could just play 3x ETFs or even just SPY shares, honestly, and you can do enough damage, right, to an account. Options are just adding it. You're going to add an extra, added piece of risk. I don't know if it's even needed when you have volatility like this. So we'll see. Let's see where Apple, TLT is up. Believe it or not, is up. 10-year. Oh, yeah, the 10 years came back under 3.6. So here's the 10-year. This is what I want to see on the 10-year in terms of this move. Is does it get, it's up to the top of that range, right? Does it kind of follow through to the downside, or is this going to, because we've seen the 10-year spike off of things like this, off of CPIs, off of Fed hikes and stuff, and the initial reaction is like obvious, right? And then maybe the backside here starts to establish, right? I don't know. We'll see. But I would at least look for this to come down to that bottom end of that trend line, or so at least back to like 3.5. If it can hold 3.5, it's still holding higher lows, and that would be a key area of resistance that it would then hold on the 10-year. So if it can do that, it's still strong. But we'll see. It's at 3.59 right now. Popped to 3.64 today. That's the high of the day, high of the year. High of the past 2 decades, right? Roughly on the on the 10-year. Months and months of bear market left. No one wants to deal with it. He blew below June lows. We will be below June lows by end of the month. I don't know what to trade. Sometimes there's nothing. Sometimes there's nothing to trade, man. I mean, there's no rush. Sometimes. We'll see. I need to slow down significantly. Not much bullish about that. Earnings recession. I think that is true. Earnings recession will probably be next. I would assume into next year. 385 puts, 386 calls at 159. You made a lousy $100 on the move. Not worth the risk. Yeah, exactly. It's not worth it, right? It's not worth it. Let it do its thing here. I think it's more, honestly, I like to look at these things and just see the reactions and see how wild the reactions can be sometimes. And it's fun to watch. It really is. Never force. Never. Yeah. And that's the way I see it on days like this. It's like, okay, what's the point? I did have one on the small account today. We've been trying not some new stuff. We've been trying some different strikes. I had a nice little win there. I think I got a really good mindset for it. I think reset and kind of watch some more psychology stuff and really just have a better trading mindset for the small account challenge, but also playing better contracts in terms of playing IWM at the monies that are 2+ days until expiration instead of playing same days or playing, out of the monies. It's been a lot easier on the contracts. Like, hey, the contract's going to, oscillate X%. That's fine. Like if it hits my stop, I take the L, and I know the L is going to be X, and it's not going to be like it's massively time decayed and volatility. I'm not going to get killed on it in those regards. So we'll see. But I mean, I'm feeling pretty good about that. But yeah, the setups are either there, and you set it up the way you like it, and you risk your level, and that's it. The problem people get into is on moves like this. You try to trade this, right? And then, like, let's say you're trying to play, long or short. Let's say you just go shares or 3x ETFs or, a little bit of leverage instead of playing options. You try to trade this today, and then it, snaps down or it snaps above your risk level or below your risk level. And you're like, well, it's just, it's very volatile. Maybe it will snap back in your direction. It will snap against you so fast that like it's too much. It's just too much to be able to comfortably be in a trade rather than, being sitting there emotional, panicking, sweaty palms, right? Sitting there like, oh my gosh. Buy some cover calls. I'm going to resell on a green day. I would love to, man. I would love to be able to, the calls, I mean, the premiums have been pretty bad for now. I mean, that's expected in this environment too. Put premiums have been pretty decent though, I'm assuming, the past couple of days for sure. So we're seeing let's see, where is it at? We got this coming up in about 12 minutes or so, and when Powell's going to come on live, and then we'll have him explain their rationale or their thoughts and whatever. for the next like hour or so. I mean, we don't have to stay on the whole time in terms of what Powell's saying listen to what he's saying the whole time, because we've got to get the pretty good gist, and the market will probably, be chilling in the next, an hour from now. We'll probably have decided like, hey, it's staying down or we're bouncing back up or whatever it's going to do, and we'll have a better feel. Yeah, but when the more you come down, again, when you have these big moves down, especially, looking at sentiment, you set up for some decent rallies, and you're going to still probably get them. Let's say we do go lower, right? The next 6 months or 12 months, whatever. You still set up for these rallies like we saw in August, or from, I guess, June to August. Like, those rallies will still probably be a part of the move. You're still going to get those types of situations. You'll still have massive rallies, right? It's just now up to you to say, okay, what has changed? If nothing's changed and X, Y, and Z is still in place, and I still believe X, Y, and Z are going to happen, then why am I going to, hold on to that or expect a breakout of this trend line, right? There's no reason to expect a breakout necessarily until there's something fundamental that changes, ideally. Or, you're getting closer and closer to that end, that end goal of whatever, Fed, this, that, or that peak fear, that peak, because the market will bottom prior to the economy bottoming, or prior to the economy finally kind of getting out of the worst of it and coming out of it. That's just how it works. So, that's like the question of like, this is the more prolonged, I guess the thing about the more prolonged this is going to be, market's got more downside to go, you would think, if this is going to be more prolonged. So we'll see, or we get some fake outs and we get some crazy moves, and I'll be there for that too if we get any of the any of the above. Believe it or not, TLT is actually up. I'm not surprised, but it's actually having a nice little day. Here's the downtrend line on TLT. This is where I still feel like I feel like this is your better risk reward than any stock, in my opinion, because who knows what's going to happen with stocks. If you go to individual stocks, you have earnings, the earnings downside risks into next year. I think that we've really priced a lot of this move in. Could TLT go down under $100? Yeah, but I think the dollar cost averaging into that with the dividend that it's going to pay you, and then selling covered calls against it, this is a better risk reward than any stock right now, I would say, for a swing. Say it's a 6-month hold, it could be longer, maybe, whatever. I think your risk of downside is in the next 6 months. So if you're going to see further downside, it's going to come in the next 6 months. And then after that, I think that you're probably going to either establish a bottom or be trending higher. I mean, we'll see. But that's my take on the TLTs, the 20-year bond ETF. So we'll see. We're look at this SPY. We're like, we've done it like every day. We've like seemingly gone to a new low or like tested lows, then like start to kind of bounce. It's like we have yet to like have that continue. Maybe today will be the day. But if we're looking for targets, downside targets, so down to like 378 is like the spot that I have in mind. 378 could be the bounce spot. Intraday bounce, or maybe a little bit of a bigger bounce back up to 400 or so. I don't know, but that's the gap fill from back here in July. Got close to filling it, man. We're close. I mean, we talked about that in July. Like, hey, that would be a nice spot for a target to the downside. It just the route to get there just didn't necessarily look as linear as maybe you wanted it to look, but that's what it is. My shark. Let's see what let's go to the 5-minute again. This thing. So we just hit a new, we didn't hit a new low. We hit a new low on the day. I guess I can get rid of this volume though, man. This volume is kind of annoying. Let me get rid of the volume. We can come back to it. It's just kind of like annoying until you see the bottom. Yeah. So low of the day was 80.25. And from that low past like 15, 20 minutes, we've bounced up like $1 or $2. Nothing too crazy. Let's see what Powell can do here. Let's see what Powell's going to do. Is Powell going to send us sub 380, or is Powell going to send us back to 390 today? I mean, you'd have to make a big move back to 390. That would be a pretty substantial day. Let's say if you were to do that from the lows, you'd have to go that's not that much. 2.5% from here is not that much. We've seen bigger. We've seen a 5% down day, right? Was that last week on Tuesday on the CPI? All right, in like 5 minutes, we'll have Powell. So today's is that necessarily like unexpected? Like not again. Like I don't think this move market wise. Obviously, maybe the initial reaction or whatever is people like, oh shoot, the outlook here, their forecast looks a little bit tougher, right? Maybe into hikes and where they see the end of hikes, whatever. But again, if you think about it take a step back, like they're making that based off of the CPI, based off the data that they have in front of them. And so that hasn't changed. Like if all of a sudden in like November CPI, I don't know, November, maybe in like December CPI that we get for the month of November in December, maybe that CPI for whatever reason, I don't know what happens the next couple of months, just comes down massive. You see how fast that could shift, and it's like, okay, well now the data is telling us like, well, we actually are, it'd be good. Like, so who knows? That's just where it's at. I just don't, again, that's the biggest move and the best risk reward or whatever was the bigger move was off that CPI because that was the shock. I wouldn't say it was a shock, but that was the bigger shock. I don't think today's shock is nearly as big, hence why we're not down as much as we were back on Tuesday. I think that was Tuesday CPI did enough damage there. So we'll see what happens now. Does Powell kind of give us give us the hammer during his speech, or is he gonna kind of just fine line it and kind of say whatever he's gonna say, and market kind of just slowly kind of just bounces back up? I don't know. Imagine we get one of those days. This is one of those days where like you can totally see the potential of like a massive squeeze out. Cause like, let's just say, right. I don't know. We can look at the put calls and see where the put calls are at. Yeah, they didn't really move too much off that, but they're still elevated. But let's just say that if that spiked, it would give us more data. But if that put call spiked, right, means people are buying puts. If everyone starts slapping puts right into this, and then we start to kind of like glide higher, you can get that squeeze out into the close and kind of like pop up here and maybe break a high of the day. Let's just say, right, if that was to be the case, if we don't, because if you bought puts a little too late on this move, if you didn't wait for a bounce back up to reshort, you're potentially going to be down on if you bought at the low of the day, you're potentially going to be down on those. And then you can kind of see a squeeze out occur for traders for an intraday. It doesn't mean that this is going to be, we have to go up tomorrow or the next day. Who knows? Right. But just for an intraday, move, so we've seen that happen a lot with Powell. I wouldn't, with these events, I wouldn't be surprised if it happens again. So it's something to keep in mind, but we'll see. J Powell said pain. Why would anyone expect anything else? I don't know. But I think everyone after that CPI, I think they took that and were like, oh shit, like this is not good. Let me just do that sound check again. Let me know in the comments in the chat. If it's too loud, not loud enough. Guys will be on in about 5 minutes. See if he'll be late. Maybe he'll be late. You can yell at him. I wonder. Yeah, let's check on Bitcoin. What Bitcoin doing? That Bitcoin must be taking a hit, right? BTC. I mean, it popped up enough to that like that downside actually wasn't that bad. It's down to the lows of we kind of saw like yesterday. You going against the grain. I like going. I do seriously like going in. Well, the way I'm going to look at it is take a step back and let's see what happens to finish off the week, and then make the decision of what my thought process and what I want to do and all that stuff. And I do like going against the grain, right? But to some degree, right, you got to be careful because if the reality is XYZ, right? Maybe going against the grain, doesn't necessarily, going against the grain doesn't always work right away too. It takes time to play out. Stay the course. Sometimes I think waiting it out. Can't really beat that right now. You can't really beat that, at least in the way I see it. So that's Bitcoin. Not really that much. I mean, if you look at the daily chart on Bitcoin, not that volatile. We had a bigger downside day last week on the CPI. So holding the lows for now. Gold and silver, let's check on these guys. Gold is flat. Was it up? It's just like kind of look at gold, by the way. Look at gold. We were talking about gold, right? And we're saying to ourselves, okay, gold down in this zone could be a good buy. But what we're seeing right now is like a classic bear flag almost, right? You have a decent move to the downside on gold, right? Right here. Geez, let me get the drawing tool. Decent move down, and then now what we had was a prior support is now acting beautifully as resistance. So this is a short. Up at that, this is a short until it can reclaim this, let's say 1680, just from the chart, right? Now today it broke down below that support, and now it's snapping back up. So maybe there's some more, more games being played there. But until that tells me otherwise, this is that bear flag. This is telling me this is a short versus 1680. I'm not playing it, but that's what it tells me chart wise. Silver, a little better. Silver's actually up 1% today, believe it or not. Nat gas is up. Oil's down 1.6. Again, the oil numbers and then the gas it helps. The trend is just is just down. I mean, if we make a new low, I would expect, $80 or even a sub 80 flush at some point now coming on oil based on just this trend and this trajectory. It seems like that's obviously going to help CPI, but you've seen how it doesn't seem like it matters enough, right? So we shall see, but yeah, I mean, I'm looking at my covered call portfolio. It's actually flat today, believe it or not. So not as volatile in specific or in individual names as I maybe would have thought, given the move down we just saw on SPY. But then again, on the day, SPY is only down 0.5. Everything, small caps, IWM, QQQ, and SPY are all down around 0.5, 0.6 right now. So that's where they're all sitting. Also, TLT is actually up almost 1%. What's the 10-year? Look at the 10-year, guys. 10-year is actually down today. Look at this. This is where it kind of gets kind of wonky, right? When you're like, oh man, everything tells me that the 10-year should go up. We've seen this happen before. Now, it has to confirm, right? We haven't gotten the confirmation of it continuing to go down. But we've seen it happen before where the 10-year spikes, and that spike is then followed by, an absolute flush out. Now, the key on the 10-year would be this breaks down below 3.5. If it breaks below 3.5, that would be more of that would be like, okay, like something's going on there. It would, that could be telling us something bigger. Until that, I still don't think it really matters. It's that the breakdown is not going to be there until under 3.5. And then after that, it still has to break this trend, which has been, hella strong. So let's see what it wants to do. But that's going to be the key. Let's see if Powell's on here. Let's pull him up. Refresh. Is he here yet? There he is. All right.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market
Spies
to come into
testing
better
VWAP.
balance over time,
Back up to
easing the
almost
upward pressure
384
on
on SPY.
wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the Consumer Price Index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for
Don't
total
look now, but
PCE
market's
inflation
ripping back
is
up, guys.
5.4% this
Look
year
at this, sorry.
and falls
Keep
to
Powell on the background. Look at
2.8%
the
next
SPY
year,
move. SPY's green again. Everything's green
2.3%
now,
in
by the way.
2024, and 2% in 2025.
Look at that massive bounce back. It's
Participants
almost recovered
continue to
everything
see risks
from the initial
to inflation
reaction.
as weighted to the upside. Despite elevated inflation, longer-term deflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer-run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
So, give it a
Hi,
sec.
Jerome. Thank you for taking our question.
We'll cover this. We'll come back to this in a sec. Let me see if I can. But, so here's the reaction off of that. So far, Powell began speaking and we pretty much bounced right. We were already kind of bouncing, but we pretty much bounced right back up, went green. So SPY is now like green, like it's barely green, but it was down. It was up big prior to the initial announcement. Then it went down. Now it's back green. Let's see what happens. The concern that I have, or it's one of the things that you could see for more of an intraday, right, is obviously they're still here saying, hey, we got to raise more because the data is telling us, blah, 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 we need to, right? So that hasn't gone anywhere. And it's going to be up to CPI. It's going to be up to that data. It's going to be up to the job market. It's going to be up to all those things, right, that we've been talking about to give them the signs and the data to say we are, getting closer. And once it becomes apparent to the market that we're getting close there, then that's where you'll probably see the bottom, or that's where you'll see maybe there's substantial rally. Because again, maybe the bottom is in, who knows? But that's where you'll probably see things at least alleviate or lift up, whatever. But that said, when you get a big move down like this, people who shorted this thing at the lows obviously are underwater right now. And so if that continues, there could be a squeeze out into the close. If it can hold up, we'll see what happens. But if it holds up, you could get that squeeze out into the close. So we'll see if that continues, and we'll listen to Powell here and see what he's got to say.
Our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Steve.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time that you can see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility certainly that we would go to a certain level that we're confident in and stay there for a time, but we're not at that level. Clearly today we've just moved, I think, probably into the very lowest level of what might be restrictive. And certainly in my view and in the view of the committee, there's a ways to go.
Okay, Rachel.
That was a pretty good question. I mean, that was, I think, what everyone's asking. His question was essentially more of like, do you see pausing rates and not just going from increasing to cutting to kind of let the economy and let that unwind and let things unravel a bit?
Should we interpret that to mean no soft
Meanwhile,
and is that kind of
really quick, I know I'm talking over this, but look at the market. 388 just hit on SPY. We're up 1%. That is a massive move. I mean, what else do you expect these days? But massive move off the lows. So let's see. And it might go for more. Let's see. So from the lows to where we are now, we're up about 2%. We're potentially going to approach that 390 on SPY. That was the big breakdown point. Let's see what happens here the rest of this press conference.
First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. As I've said, there's no basis for complacency there, but to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say, how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, or rather increase in unemployment and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Just to follow up on one small thing, are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles, where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick.
Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know. You look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see, at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Howard.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby.
Thank you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we.
My bad. Real quick, look at this. SPY pulled up, hit up to that 389.25 area, and then it pulled back down just below the range of earlier today, and then it's bouncing back up to the top end of the range. But what's really notable, look at this. 10-year, guys. This did exactly that. Well, it's doing right now. We'll see if this continues into the end of the week, but it's doing kind of what we speculated could have happened here, is that off the initial reaction, it spikes up and we hit 3.64. It's done this before off these types of situations. And then after that, it just falls off. And what it's doing right now, it's actually down on the day after being up substantially. And it's kind of giving a lot of that back. Look at that move. That's a pretty notable move. And that could be kind of that last little spike before maybe a pullback here in the 10-year. Again, this is gonna front run. The bond market's going to front run, what the Fed decides to do in terms of pausing and cutting. So they're going to be way ahead of this. That's the thing. We're looking for this as the signal for, are we getting close? That's just what we're looking at. And it seems like maybe the signal is that it's we're, as the weeks and months go by, we're ultimately going to get closer to that point, right? So it seems like the bond market, maybe if this continues, obviously we got to see this thing fall back even further and get out of this little consolidation here. But that's notable. It's a pretty big move down, or at least from where it was just a half hour ago on the 10-year, just like that. So, yep.
Have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Thank you. Neil.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I, just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment and price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times, but really we're in very different situations. But I will tell you that our contact is more or less ongoing, and it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong. But there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest-sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash, so there's good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that, and that's a good thing because that means the economy will be more resistant to a significant downturn. But of course, we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike, thank you.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below-trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward-looking and the lags in your policy are forward-looking and you don't know what they are, how will you know or will you know
Look at that.
if you've gone too far?
Looks kind of weird.
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this
It's going to
year
walk
for,
that
my
fine line.
colleagues
Like,
and
I don't want to say it, but like we're
0.2%
probably going to be in a
growth. So that's
recession, but
very
like I
slow
don't want to
growth.
say it. You know what I mean?
And then below trend next year. I think the median was 1.2, also well below. So that's a slower. That's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this. Inflation, what we hear from people when we meet with them is that they really are suffering from inflation. And if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
How will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris Rugaber.
Thanks. Chris Rugaber, Associated Press. I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability. And you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of the rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that inflation, high inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion, and this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment, and the way we do that is by slowing the economy. Hopefully, we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability, and I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So, I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Thank you for taking the question, Mr. Chairman. Edward Lawrence for Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our projections today is that inflation moves down, significantly over the course of next year, and then more the next year after that. And I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy's improving, and also if our projections are close to right, you will see that that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs, and we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got inflation under control. And that's not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year, expansions. And you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight tight monetary policy for a period of time.
As a follow, what is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises. And so we want to avoid that. We want to act aggressively now and get this job done and keep at it until it's done.
Nicole from CNN. Thank you, Chairman Powell. Nicole Goodkind, CNN Business. Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week, and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There are also longer run issues though with the housing market, as you know, where it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
Shelter made up such a large part of this hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there's still this imbalance that needs to be addressed?
I think that shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly clear when that will happen. So it may take some time. So I think hope for the best, plan for the worst. So I think on shelter inflation, you've just got to assume that it's going to remain pretty high for a while.
Okay, we'll go to Jean for the last question.
Hi, Jean Young with Market News. You've talked about the need to get real rates into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6% expected? Is that expected to be next year? How restrictive?
So I think if you look, when we get to, let's assume we do get to that level, which I think is likely, what you're going to do is you're going to adjust that for some forward-looking measure of inflation, and that could be, you pick your measure. It could be, there are all kinds of different things you can pick, and you get. But what you'll get is a positive number. In all cases, you will get forward inflation expectations in the short term, I think, that are going to be, assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point, which could be 1% or so. But I mean, I don't know exactly what it would be, but it would be significantly positive when we get to that level. And let me say, we've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, And we're going to continue to watch incoming data and the evolving outlook and ask ourselves where.
Okay, so we're kind of getting towards the end, it seems like, this. All right, so really quick, let's just recap what the hell just happened the past like hour and a half. Well, past like hour and 15 minutes, really. Pretty nuts movement we've been seeing. So 75 basis point hike is what we got, right? We got that at about an hour and 15 minutes ago. That comes out initially. Let's zoom into SPY for today. Give it a second to adjust. Initially off of that, market's up towards highs, right? Hits up towards high of the day, pretty much right in line with high of the day, right? Double top there earlier this morning, pretty much did the same thing again today or this afternoon. And then hammer, right? Drops the hammer, boom. We drop off from that point, from that high or that relative high, 387.20. We dropped down to 380.25 roughly. So we dropped about almost 2% in a matter of like 10 minutes, not even. And then ever since then, we kind of chopped around for a bit. And ever since then, we kind of bounced back. Powell started to talk. We bounced back. We've given some of that back, but we are still, the S&P is still up on the day. The volatility is not subsided yet. Obviously, we just saw it gave a lot of that back, and now we're snapping right back. We've just bounced like $3 in the past, minute that I've been talking now on SPY. So hit a high here of 389.30. We're going to have, that's going to be a resistance area. I mean, it's going to be, because if you zoom ourselves out and you look back, that's where we got up to in pre-market hours back on here on the 19th. That's also the lows. That's lines up pretty darn close with the lows that we saw. 390 around 389. That's going to be, it's a volume. We have a volume gap up until that spot, and not much volume traded from 386 to 390. So that's kind of why we shot right there. I think that's partially why we shot right there. Also, not to mention, you have people who are shorting right into that move, who chased shorts, who then covered back into that move back to the upside. Partially, that's kind of the deal. And now we're kind of in between. So yeah, we're still up on the day across the board. We're in between. But notably, right, there was one more thing I want to mention here really quick is the 10-year. Look at the 10-year, guys. We got initially 10-year spikes up. Oh my gosh. It's at 3.64. And ever since, it's been coming down. 10 years now at 3.51. I'm thinking that this 3.5, and it's so far, we kind of bounced the past few minutes. 3.5 will be a key spot on the 10-year to hold. If that gives away, we start coming down on the 10-year below 3.5, then it's going to be, do we break this trend? Which would be, if we were to keep coming down, that would be, maybe tomorrow. We'll see what happens. That's going to probably be around a 3.45 or lower. We start breaking down below 3.45 into the end of the week. Very good chance that this trend or this channel that we've had the past 2 months will break, right? So that's the question, right, that we have in the 10-year. So it got up to the top of that channel, but still respecting the channel for now. And if it can hold, the upper 340s, it'll be fine. It's still in the channel, and that's the key. So that's what we're watching right now on that, and that's essentially what's going on. But this is not something we haven't seen in the past. Like, we've seen these moves in the past, but the 10-year either dumps and then starts recovering hard, or it rips and then it comes back. And this is the 10-year yield. So it's kind of doing that rip and dip type of movement right now. And as we speak, let's look at the overall market. So SPY is up 0.5%. QQQ is up 0.75 or 0.7 roughly, and everything's moving so fast. It's tough to say exact. And then IWM small caps are only up 0.7. The Nasdaq the Dow is up 0.1. The Dow is not up as much. VIX is down 3.5%. The 10-year is obviously down. We just talked about the 10-year. Put call ratios are sitting around 1. DXY is off the highs. It's come back a bit. The dollar index, Tesla's up. NVIDIA's up 4.5%. NVIDIA is the strongest stock on my list here today, at least across the large caps I like to watch. So some strength there. So semiconductor stocks doing pretty well. ARK's up 1%. Amazon's down. Biotechs are down. But across the board, things have bounced back, obviously, from what they were looking like just, a half hour ago or an hour ago. About an hour ago, after an hour ago was the dip to the downside there. So now we're sitting above VWAP, and believe it or not, right, we may actually be setting up to now intraday. There was volatility. We might, if we flatline here and finish between like 384 and 386, it's possible. We end up having kind of like a nothing burger, like we were saying before. Like, that was potentially possible to have a nothing burger where we kind of just flatline by the end of it all. Let's see if that's the case. If we finish in this range, we're up around 386. Let's see if we can, maybe 387, top of that range. Let's see what happens. See if Powell's got anything else to say here. Let me refresh this to make sure that it's up to speed. Oh, they're done. So they're done. So they are done. So we can just hang out and talk about what the hell just happened. So that was That was a lot, right? We just had a lot happen in that past hour and 15, But wow, geez. So it seems like, well, not seems like, they're expecting the hikes to go through next year, and then I guess backside or cuts to occur in 2024, if I'm not mistaken, from what we saw earlier. They had a bunch of those. If you want to fast forward, rewind back to when we just started talking from Powell, he had a couple of charts giving you kind of like some year by year mean expectations and where the committee and everyone is kind of at in terms of where they think things will be. Rates, this, that, inflation numbers, all that kind of stuff. So that's kind of cool to look at. But that said, we're kind of just sitting in between the range of the day. So we are like right in the middle of today's range. We've obviously been down towards that 380 and we've been up towards 390. So about roughly a $10 range, about a $9 range today on the day for SPY. Actually, it's almost exactly a $9 range. So we're kind of like right in between that range right now as we speak. Whew. Back down. It's bouncing around. China's impact on inflation. I'm not sure how much of an impact or how much we're looking at China in terms of he was talking about, what I think was important was he was talking about the housing or rents and stuff. And I think that's going to be a challenge, right? That's going to be a challenge because housing prices come down, but when housing prices come down and interest rates go up and mortgage and the cost to buy a home goes up, right? So you go rent. So that means that there's more demand for rents. So rents are going to stay relatively elevated, and there's going to be a little bit, it's going to take longer for that to come down, theoretically, right? That's the idea. So he was kind of saying, hope for the best, expect the worst there, expect rents to stay high for a bit. But, we can hope that they start coming down, with the market and with their impact and stuff. So let's take a look at what's going on here. Let's see the put call ratio. I'm just going to check it out here on TradingView to see how it's moved so far today. Let's go to the 5-minute chart. Not too much. It's kind of flatlining here. We kind of got a good even mix, at least so far. Not too much of it's still skewed towards puts, but because the average is like 0.7 roughly, but it's still up there. I'm about 1 right now as we speak. Let me check out CNBC's CNN's five-day average of the put call ratio. This is sitting here. Today it's come down off where it was the past couple of days. It's at 0.96, which is still up around the highs that we saw back in May and even into July. So it's still relatively high, but it's come down, a decent bit. So there's that. Again, TLT, we're talking about the 10-year going up or the 10-year coming off. TLT looks like, if we broaden this chart out, it is trying and it's actually doing it. Pullbacks from here, I think, are, if this trend line is the break, which is, only so far the past month, past 3 weeks of action. If this trend line break is confirmed, then, any pullbacks versus, I would say versus 107 would be a nice spot for a long there, just from a technical perspective, if that area holds. We looked at Tesla before a few minutes ago, or before the whole meeting. Tesla dipped down below, and now it ripped back up to hit a high of the day, hit a high of the week, and then now it's kind of back around VWAP, sitting right here on this 309 area right now, kind of just in between. Apple, where's Apple right now? Apple's down. Apple was up yesterday a lot, and it's now back kind of in between. We're kind of falling back to middle of today's range. Same thing with NVIDIA, a lot stronger here on NVIDIA. So maybe the semi stocks got some more strength, at least potentially relative strength today. It's sitting here obviously up 3.5%. It was up, it hit up over 140, believe it or not, here on NVIDIA. The chart here looks pretty nice in terms of building that, higher lows and trying to round the corner. If it can hold over 130, looks decent for, for maybe some of these gaps to fill up towards 150 in the near term. If market wants to, cooperate and doesn't dump to new lows. So we'll see if that ends up holding up. But yeah, let me just double check over here, see what other action we have across Webull, top gainers. What's going on across some of these guys. Let's see, any big action. Give it a second to load up, and we'll see what we got. PBTS, oh yeah, Bitcoin ripped face. PBTS, that's an interesting chart. 50 SMA bounce, by the way. Bitcoin just has gone up. Let's see where Bitcoin's at too. The market's pulled back a bit from where it was, about half hour ago. But I want to see where Bitcoin is at. So today's top gainer, SLI or SLNG Sling, or it looks like Sling to me. It's off the highs. Moho was a prior runner in the past. Yeah, Moho's having nothing crazy across small cap land. Nothing too crazy really across small caps. today. But let's check out on Bitcoin and see what that's doing. So Bitcoin is up about 2%, just under 2%. It has pulled back off of where it was, similar to so it's kind of, everything's kind of doing this chop, right? We're kind of in this chop, and I think you're kind of getting a really nice burn of everybody. Everyone's kind of getting burnt out here. Calls, puts, no matter, unless you played off that, unless you, got puts at the highs or got calls towards the lows, you're kind of in this weird limbo right now, at least today. And we're going to have to get more action towards the end of the week to see what continuation move we're going to see on that. But the 10-year has been notable. So the 10-year is coming down, which is an encouraging sign for stocks potentially. More, growth names or, maybe crypto, more risk-on assets potentially. So we'll see. Bitcoin's up here over 19.4 right now. Bigger picture on this Bitcoin chart. It's still, holding those lows. It's still down there towards those lows. And as long as the 18 handle holds, it seems like that's what's trying to be support. That's trying to hold as some support for now. On Bitcoin, gold is up 1%, silver's up 3%. So look at that, gold move has bounced right back. We're talking about gold as a short versus 1680. Well, guess what? Gold just ripped back over that 1680, and this was your fake out move. It looks like on gold, a lot of fake outs. It seems like today, market wise, up and down choppiness. Gold and silver, we're kind of making some moves. We got the 10-year right here, just now teetering on 3.5, fake out move there. 10-year popping to 3.64. Now it's down to 3.5 all in the same day. This is like a small cap stock right here. This is nuts. The moves that we're seeing. The volatility is certainly still here, right? So it's not a bad thing, right? If you're looking to make money or profit off this stuff, but it's obviously, it could be pretty wild, at least when you're involved in it, while it's happening like we're kind of seeing right now. So what a ride. OCGN, check it out. Check out OCGN. OCGN, I don't know what's going on with them fundamentally or what the heck's the company is up to, but let's take a look. It's down towards $2. That's a bottom out look, man. That's an interesting look on this chart. Now, I don't know if I'm a big fan because they can easily continue to bleed out, but this thing hasn't run in a while. It's been a while since it's ran, and its last run was late last year. Had a big move up to $17, almost $18. And has been unwinding ever since. But now it's trying to hold up. It's trying to kind of hold up around $2 or the upper one. So if it can do that, I guess that's a good sign. But yeah, a lot of small caps. We were talking about Grill a couple weeks ago, and now I was looking at Grill this morning. I'm like, man, Grill looks pretty good, just chart wise from what I can see here. It's just kind of holding on that 40-cent level. Yeah, could it drop down to like the mid 30s? Yeah, or even low 30s? Yeah, I don't think that's a problem. It's trying to hold the 50 SMA, but this is another one of those small caps that just is like, primed for a run at some point here. Need some positive news. They've got some good cash, a decent cash position, I believe. But you'd want to see them. We're going to see if we get further moves to the upside in some of these small caps, some of these explosive moves that we've kind of been seeing over the years, past couple of years. Not as much. We still get them from time to time off of PRs and stuff, but selectively there's some stuff out there, I think, for sure. So now the markets have gone red. IWM just went red. Barely, it's flat. SPY is now down 0.3 on the day %. So it's down towards that 383 level on SPY. It's just, again, it's kind of in the same range from this week, believe it or not. So despite all today's, craziness, what are we kind of getting at? Not much, at least until for now. We have still yet to get much direction. We're still in this little range. If you want to flush out and dump lower, maybe that's going to happen to finish off the week. Sure. But it's just kind of jumping around. It seems like you're getting these, when you get a little too aggressive on the put side, it squeezes out. When you get a little too aggressive on, buying the dip, buying calls again, it seems like it tends to dip. It tends to flush out. It's kind of like playing everyone both ways. Yeah. Best thing to do sometimes is hold out. Yeah. I got some ice in my mouth. But yeah, that's just how I felt today. I wasn't really interested in doing anything, and here we are. Now we're kind of dumping down back towards the lows. We're coming in about $1 or $1.50 off the lows now on SPY, coming down to yesterday's lows. Maybe this is a bounce zone. Let's see where the VIX is at. The VIX, believe it or not, though, now the VIX is back up. So the VIX making some crazy moves. VIX immediately spiked to 30, and then now it dipped right back down to 25. That's a big move on the VIX to 25.50, and now the VIX is at 27. So the top of the range the past 2 weeks has been up here towards around $28 on the VIX. So you want to see if the VIX can, or if it gets above 20, it makes a sustained move above 28. That's a obviously a look for downside in the markets, but that's kind of the spot. 28 bucks in the VIX is kind of your spot. Here's DXY, popped to almost, well, it looks like a 111.50, and then pulled back to 110.6. About pulled back about $1 on the dollar index here. Look at that, and now it's kind of splitting in between. It's right in the middle now. But the 10-year is not really bouncing back as much, so we're kind of having like this big kind of back and forth. The 10-year has been more decisive in its move in terms of it made that initial, fake out almost, and then now it's dumping back down to 3.5, and it's, I would expect this area to hold up. This is going to be a key spot, 3.5. Why? You go back up to the left, right? That was the highs of June. So if it's going to if it's going to keep going higher, you would think that this is going to hold those, those past highs. It doesn't have to, but this area, is going to be a key spot to see if it holds. So we'll see if the 10-year ends up holding this 3.5 the rest of this week. That's the question. But yeah, I mean, the crazy moves, across the board, right, today. Nuts. But do we expect, I expected nothing less, right? Based on how this, how everyone is like, oh my gosh, the Fed, they're just waiting for, they're so trigger, happy, it seems like, on this everything CPI Fed. And so you get these big moves and everyone's jumping around, chomping at the bit, doing this, doing that. So it's a good thing and a bad thing. It's plenty of volatility. So there's plenty of move, right? But if you're on the wrong side, obviously it can be pretty nasty. So that's what's going on. Now we're back to the red. Let's see if we hold this area. This is yesterday's lows on SPY. Let's see if we hold this 381.50 on SPY. So let's see what happens. Some massive volatility though, because we were up here towards 389 plus, and now we're back down to 381.50, all in a matter of like a half hour. The past half hour. So it's wonky moves, but volatility, man, is seemingly here to stay. So, geez. Maybe we get a test of these. We're testing yesterday's low. Now maybe we get a test of this afternoon's low. Look at that. Now we're coming back after all of that, squeezed out early shorts. So talk about getting getting tossed around right now, right? If you went and got puts after that move down, you were probably shitting your pants up here, thinking, oh my god, and you probably squeezed out, stopped out. And now you're like, oh my God, I could have had it, right? If I just averaged in, I could have had it. But, again, it's like a random moves. So, can you necessarily stick around for that whole thing? I don't know. If I wouldn't have done that. But Powell's done speaking for now. So we're kind of getting things starting to settle, and they're settling down to the downside across the markets for now, but nothing terrible. I'm saying, like, when I say terrible, I mean like it's all relative. Based on what we've been seeing, if we were down 2.5% today, that's it's a pretty bad day. We're only down about 0.8 from where we were about a half hour ago. Yeah, it's a pretty big move down. Don't get me wrong, but it's nothing terrible for now until maybe this breaks. If this low breaks, we still got about a half hour to go into the close. If this low breaks, maybe you're going to get, I'm sure the sentiment is not going to be people are not going to be feeling good going into tomorrow if we finish towards lows. If we finish up towards highs, maybe people are feeling a little bit better going into tomorrow or the rest of the week. So you're seeing the wonkiness now. Yeah, we're coming into lows, man. We're about 25 cents away from hitting new lows on the day. We'll see if this area can hold. If it can't, man, I would think that we're going to flush 380. We're going to flush below. Maybe we're going to fill that gap finally. Look at this. Yeah, we're about to hit new lows here. We're going to fill this gap now, maybe. This purple box, we're finally going to have a shot at it here. Talk about a crazy day, because we haven't seen, I can't remember a Fed meeting or CPI even similar to this, where we had a massive move down. It was the wrong, and then of course that was the fake move, right? We had the bigger move, then there was a kind of a fake out. We had a big move up, so there's that. Now we come right back down. Here we are back down towards the lows. Do we kind of get follow through down to flush out these lows, or are we about to bounce right here and do a little double bottom action on today's chart? I mean, we'll see what happens, but I think that we're probably going to still get some big moves into the end of the week. I would expect futures tonight to be pretty, to move substantially, gapping up or down, I would think, by a decent amount. I would think, based on how this stuff is playing out. 10 years at 3.52, so it's holding at 3.5 for now. But But pretty nutty action here. We're trying to hold a double bottom, but if we break down below, my spot that I liked, months back was around this 378 on SPY. Was a nice gap fill. I would have been like, it would have been a nice spot back in July. Had we gotten it, I would have been feeling better about adding in, or I think I had some cash at the time to be adding into stuff, but it doesn't look like we're going to get that. Or at least we didn't get that back then. Now maybe we actually get that. It does look like we might actually get that now. So again, today we got up to the highs 389, just over 389. Again, that 390 is going to be a tough spot. That's going to be resistance. It was the key spot back here, right? We had this zone. I'll draw a zone in now because it's probably better to do. But yeah, well, that little white box. I kind of like the contrast the white box does. So I'm going to keep the white box instead of the purple boxes going forward. But yes, this is the spot. So we had lows right here down to 390, and then a couple wicks in here, a couple areas of resistance so far. So this is going to be key. You break 390 back to the upside and get above that and hold above that. It's a good shot. We got to move back up to maybe 400 on SPY, 401. So for now, look at this move here. By the way, for now, pretty much your double bottom. That's pretty much your double bottom action right here. Boom, boom, came down within 10 cents of that low. Pretty impressive. So the same buyer who bought down there was essentially buying again as we came back down. So someone likes SPY down here. Someone does. Let's check out the volume. Let's add the volume back in here and see what the volume looks like. Give it a second. Yeah, decent. Let's check out today's volume overall. Today's volume overall is going to be, looks like we got 30 minutes to go. It's about the same as yesterday and the day prior. So we should have a decent volume day. Probably lines up closer to something we saw last week, I'm guessing, in terms of volume today. So pump and dump and then pump and then dump. That's the kind of day we've had, right? If we go back green, oh my God, taking us for freaking a ride and a half here. If we end up finishing green, it's still got to make a pretty big move back up. But you see how the volatility, man, is certainly here off of these moves, right? Geez, $9 range. And we've essentially done that like 3 times, or yeah, I guess. Well, from 387, we fell about $7. Then we bounced about $9, and then we fallen about $9. So almost 3 times. $9 range. All in the past hour and 35 minutes, by the way. All in an hour and 35. Pretty crazy. Pretty crazy. So DXY is still holding up pretty strong. That's the dollar index is still holding up relatively strong, which is not necessarily a good sign. This stays parabolic. When this eventually breaks down, it will be, it's probably pretty substantial because you've gone parabolic this past, year or so, past like year and a half, 2 years. But no signs of that yet, right? No signs of it yet, unless this is the blow off. Unless today is the blow off, and then it's going to reverse. We'll see. Maybe that 10-year, same deal. Maybe today's the blow off. Let's just broaden this 10-year chart back out. Or, maybe today is the blow off, meaning we hit those highs and then now we give back. If we give it back and we start breaking down the 10-year, we'll see. But I'm going to guess if that's the case, then you're going to have a nice run on TLT for the next, 6 to 12 months is my take on that guy. Let's see. Let me check on my covered call portfolio. It's flat today. It's down only 60. It's only down 0.7. Where is it? It's down 0.7%. No, it's down about 1% now. That was pretty impressive, though. It was up a good bit. Yeah, it's holding up relatively well, given the market's down a decent amount. TMF, that's why. TMF is up a little bit today. It's holding me up. But yeah, we're going to have to probably wait till the end of this week to get better continuation moves and to get a better feel for where we're really going to head, right? So initially, everyone was like, oh my gosh, we're going lower, right? Off the initial reaction. And it looked like, okay, yeah, probably going to go lower after this move down. Then Powell starts talking. We rip back up. Powell, was gracing us with his presence again, and the market liked it. And then have given it all back since he stopped talking. We gave some of it back as he was finishing up, but pretty much gave it all back as he stopped talking. Anything like super notable out of that? Realistically, it's the same deal he's been kind of saying. But you can kind of see that the progression it looks like going forward is that maybe there's a 75 coming next meeting. So if we go to the Fed hikes, November's meeting, maybe we're looking at like a 75. Yes, I think we're going to be looking at a 75. The projections currently favor a 75 next meeting. And then that's November 2nd, by the way. Let me go pull that up. Again, November 2nd, the projections favor a 75. There is some projection here for a 50, I believe. And then there's even a slight chance of 100, but that's the look for next meeting. Most likely a 75, I believe. Is that? Yeah, that's what we're at 300 to 325. And so 375 to 400 would be, 75. So that's where the projection is at for November. That's November 2nd. So a little bit over a month till that one. 41 days or 42 days roughly until that one. New lows, SPY, new lows. New lows just hitting now on SPY. Let me get rid of this volume so you can kind of see it a little bit better. New lows just hit on SPY. Down below, we're testing 380 now. We're testing 380. See if we can break. Let's see if we break below 380. 378 is a SPY. Yeah, there it is. 380 is now broken. So look at that. SPY is down 1% today. It's down. I mean, I feel like it hurts, but I feel like it doesn't hurt that bad. I don't know. Doesn't seem like there's absolute carnage right across the board, across a lot of stocks. So I don't know if we'll see what happens if this continues, right? But I don't see massive carnage really right now today for now. Obviously, if we really flush out to the rest of the week, I think that would change. But, we still got some stuff that's up. Let's see. And NVIDIA, believe it or not, is actually holding strong. It's actually up 1.5% still. Amazon down 2.25. ARK's down, about 1%. XBI about to test $80. It's biotech ETF. Apple down 1.25. Tesla 1.5. Yeah, so we're getting some more pressure now as we start to push lower. Yeah. Yup. A lot of mixed signals. Yeah, I mean, you would think too, because the 10-year has been, bonds have been pretty important, and they're coming down. So you'd line that 10-year up, that 10-year move that we're seeing, the fake out kind of move today on the 10-year. You'd line this up with, I would think, the market would be a little bit happier. But I guess you got to break down more. So we'll see a lot more to come down, I guess, on that. So that's kind of a weird, I don't know, I guess a weird way to look at it. But then again, it's, let things unravel for a bit. Let's unwind for a bit and see. Now, yeah, we're really kind of coming down now. As we broke that low of the day. 380 broke quick, and now we've dropped about $1 from the low of the day. Pretty fast on SPY. And so we got 20 minutes to go until close. Maybe we're going to fill this entire gap in one shot. And if that occurs, then that's, to me, looks like a decent spot for a bounce. We'll see, though. We'll see. We're into a really nice, I guess now we're getting to a pretty good bounce zone right here based off that gap fill. And then we're coming down, I guess, below here, 370s, low 370, 372, down to about 371, and then if that breaks, good chance we're going to lows. But we're still about $20 or so off, $18 or so off of lows to make new lows on SPY. So you still got a decent way to go down to hit new lows if we're going to hit new lows on SPY. But that's the look, at least as we speak right now. Let's see what ends up shaking out to finish off the day. If we end up testing into this box and maybe bouncing to close off the day, or if we flush and we finish super weak into the end of today. Yeah, I mean, it feels like rip the Band-Aid off. Yeah, I mean, I get it, because it's like, why do we just, you're kind of playing everyone up and down and up and down. It's like, if it's going to die, just die, So I get you. But yeah, let's see what if we get a weaker, if we can push down lower and get a weaker close. Some buyers trying to come in now, but that's the deal. We talked about the Fed. We talked about next month. We talked about the 10-year. It's at 3.51 right now, just chilling right there. Get rid of Powell's speech. We talked about that. Yeah, I'm curious what CNBC is saying about this. Let's see what the headlines look like. Fed raises rates by another 0.75 of a percentage point, pledges more hikes to fight inflation. Forecast hiking rates as high as 4.6% before ending the inflation fight. that's what they're thinking about getting to. Again, we talk about this stuff all the time. But realistically, like, yes, that's where they're forecasting. They also forecasted, inflation to be transitory. They've also forecasted X, Y. There's a million. You can forecast all you want. It could be higher. It could be lower. So it depends on the economic data we're going to get. You know what I mean? So if CPI comes crashing down to finish off the year, doesn't look necessarily likely, but if it does, maybe there's a different narrative there. If CPI stays over 7.5, stays over 8% by the end of the year, maybe that is pushing up towards 5%, right, in terms of hiking rates. And so you can see how the narrative will change, right, substantially based on, based off of the CPI and the data that we get from the economy right now, really, or going forward. People on SPY go up and down, up and down, up and down. Yes, it does. Today was one of those days, right? So you kind of, again, if you played it, well, based off the levels we kind of were looking at in terms of this being a prior area of support, and it was a resistance back here. We got up into this area back on the 19th. What was that, Monday? And then dumped off of that or fell back off of that. So yeah, this area has been tough to break through, right? 390 is going to be your spot that you're going to struggle, I think, on SPY for now, until broken or until proven otherwise. That's the spot. So, yep. Now tomorrow the question is going to be, do we get follow through or is it just fake out? I mean, do we go up and then what's the follow through going to be? Is there a follow through? Yeah, no one is safe. That's how it feels these days. No position, no put, no call is safe. No option, no hedge, no anything. Put call ratios. I'm surprised. I'm kind of surprised that they didn't spike higher up. Look at this. So we're getting it now, right? Look at this. 378.85 now, pulling in. We're about to hit that. We're going to fill that gap. So now all gaps on this chart, or at least downside gaps, I believe. Now there is technically one right here. There is one back in here down to about 370, 369. So almost all these. This is a small one, but that's the next one. Imagine we came into that. Jeez. That one could be next. But yeah, this gap is essentially filled. We pretty much filled it. So that's done essentially now on SPY. Here comes the pain. Maybe, if I'm looking at this from a technical perspective and I was looking to trade, I'm not right now because it's too volatile, but if I was, this would be a bounce. This would be versus 378. This would be a bounce spot. So if I was looking to play the reversal here, it's dangerous, but we've seen there's some pretty big bounce backs. So today, so I wouldn't be opposed to something like that on SPY. But yeah, we're getting close to that 378 now. So crazy moves, man. Popped right up into that 390, faked us out, faked bulls, fake shorts, fake bulls, and then now it's going down. I guess based off of the initial reaction or based off the initial report, would have thought. But again, you get some fake out moves up and down, and today is nothing short of that. Look at that bounce so far, about $1 bounce already. Bull's going to fight back harder. At some point, that will be the case. I think it's going to be more of a fluid situation too. And if the 10-year can confirm, if bonds can confirm, then that will be the start. Bond yields need to start the party. If yields can come down and and then the CPI can confirm, the party can actually go, but it takes its time. It's gonna run its course and it's doing its thing for now. But maybe you have some signal that yields might want to try to come down. Let's take a look at some other yields here. So we got let's go to the 2-year. What's the 2-year doing? So the 2-year had a same deal. It spiked up to 4.12, came back down under 4. Now it's back over 4. So the 2-year is kind of just still the trend is still up. So it hasn't really reversed trend there. Let's see what else we got. Let's look at the 30-year. Let's look at the 5-year and the 30-year. 5-year, same deal. 30-year, let's look at the 30-year. 30-year a little more volatile, but kind of the same deal. It's still holding uptrend, and then the 10-year is same. I guess for now it's holding up 3.5. So unless bonds, the next couple of days yields, really start to unwind a bit and unpack this this meeting, maybe. Seems like they're still still holding those higher lows. They're still looking strong. They haven't broken down. They have yet to break down. So into the close, SPY down 1.4. I mean, we've had a ride and a half today. SPY down 1.4, QQQ down 1.5, IWM down 1.4. That's the deal. October could be, I think it definitely could. But you're going to be riding on the CPI. It's going to be riding on a lot of these things that need to kind of happen, and they haven't happened yet. So, but like we say, when they do happen and when they do occur, it's probably going to be, too late in a sense. So, we'll see, but it's probably going to be I say too late, but in terms of looking for bottom fishing, you're going to be probably too late. Once the masses are on board with, okay, let's turn it up, right? Let's run this up. The bottom will be in, and they'll probably be in for a bit. So we'll see. But if you look at the big picture on SPY, you're getting down to now, like, what is this? You're getting down to, I guess you kind of gotta hold this if you want the inverse head and shoulders look. But if not, does it have to hold up? No. But, you kind of got to hold this area. And if you do hold this area, that would technically be an inverse head and shoulders. But again, that has to prove to hold. So we have got to see that actually hold. And we have yet to, there's no confirmation by any means on any of that. So give it some time. But if this upper 370s and 380 area holds up, it could be something to keep in the back of your head. Chart-wise, at least from a chart perspective. But looking pretty weak, though. Last 10 minutes of trading, it's pretty weak into the close here. Yeah. I mean, 378.25 was the low of the day. Okay, so look at this. Let's see how this ends up shaking out. We literally came down. This box I've had in here for months. I drew this in June or July. We came down to literally the bottom of that box. And I didn't adjust this box since then. To that bottom area. Let's see if it ends up actually holding. Sometimes, you draw these levels in, you forget about them, and then they end up proving to be perfect in hindsight, but you don't take the trade. I'm just not interested in trading today, right, especially after this volatility. But because, again, if you bounce here, good chance that, well, it depends on how strong of a bounce it is. Yeah, I don't know how much the VIX will do. But the VIX is kind of flat, so it's possible the VIX could unravel a bit, and maybe it hurts a little bit of volatility, on the options. I don't know. You need a decent-sized move, and there you go. You're getting it. You've got about almost a $1 bounce. So it's kind of working. And I would think if you're playing this for an actual trade, right, the idea is that I would look for maybe the prior area of support to be resistance. So I would say 380. So looking for 380 to hit as a target. Let's see if that actually happens. 380 would be right in here. Let's see if that line hits. If it does, that would have been a killer trade. Looking back. Man, I'm going for almost 2.5 hours. Just nuts. What has occurred in the past 2.5 hours, man, has been just pretty nuts. Whew, man, what a day. What a day, to say the least, right? 379.50, or about 50 cents away from that hitting. Sirens going on in the background. The world is ending behind me. That's what it sounds like outside. TMF is up over 10. CLT is actually holding up decently. The 10-year is at 3.52. It's come back. I want to see if that gets any continuation into the end of the week, on the 10-year. If it does, this could be a buy the dip. If not, I mean, the bond market's been guiding us. If we kind of catch and 3.5 holds on the 10-year yield, a good chance we're going to keep the pressure on, right? Market-wise, pressure should stay on if that ends up holding on the old 10-y. Kyle's back from the gym, but he missed an absolute wild afternoon. Yeah, it's acting like Bitcoin. Yeah, it is. I mean, today kind of was one of those days where it didn't do what we maybe had done in the past to a decent degree. If we kind of finished, flat, 385, 384, I guess that's kind of in line with whatever. But we kind of had that initial move down, right? And then we got the reversal. So we got a big reversal back up, and went fat green. But did we necessarily think that we're going to go from fat green to fat red? I don't know if that was in the cards in terms of past moves. We hadn't generally seen that. We tend to get, 2 moves and maybe give back some of that move, but not all of it and some. But no, yeah, we got all of it and some. So that today's intraday range is now, just about $11 or around $11 on SPY. So, volatility is back, ladies and gentlemen. It is back, and we're only about $18 off of, or $17 off the lows of the year. So, not too far off, realistically. Jeez, not too far off. But 10 years keep giving 10 years red on the day, so that's something to keep in mind. Note. But overall, though, S&P down. Okay, so S&P's down 1.25%, 1.5%. Everything's down the same. Dow, Nasdaq, and S&P are all down around between 1.3 and 1.4%. Not a terrible day. Not a terrible day. Could have been much worse. Meta's looking terrible. Let's see. Meta's 1-year chart. Once it broke down and we had this area, this is the downtrend, so it didn't break the downtrend. It looked like it could maybe have, prior to that CPI reading on the 13th, but it did not. Once it broke below 155, you've got a nice move down. So this doesn't look good, although I will say, if you zoom this bad boy out, you're coming down to pandemic lows. You might be looking at a decent idea, a risk reward versus pandemic lows. Here on Meta. And then prior to that, so the 2 next spots to, I guess, look at in terms of maybe their ad zones. If you're looking to buy this and dollar cost average in, spot number 1 is down, from here down to about 137 is the pandemic low. And then prior to that, the 2018 low is down at, what is this? At like 123 roughly. So you're getting down to some pretty good support spots. Now, obviously, if, does it have to hold? No. But chart-wise, this could be a pretty good risk-reward, right? Down into this area. Or if you're looking at dollar cost average and you want to bet on the metaverse going forward. Not really, you haven't been able to get Meta or get Facebook this cheap since the pandemic. And then prior to that, since 2018, 2019. So if that's the type of deal you like, or if you're looking at Meta saying, I like the company, then you got a decent deal chart-wise. Fundamentally, they're going to be in a situation where they're investing pretty heavily into the future, and so they're putting money. They're just investing right now, and they're saying, okay, we're going to just do what we got to do, blah blah blah. And will it pan out in this environment macroeconomically right now? It's a tough environment for this type of stock, but in 5-10 years, could we be in a different situation? As Powell said, right? As he said, right? We set ourselves up by keeping inflation low for those, 10-year, really, really strong, periods in the market, really 10-year strong economy, right? Runs. And he was kind of saying that's kind of what he was looking at or talking about. So you got to have this to have resets, to have that, to get that continuation. Most technology stocks reaching lower PE. Yeah, they've come back a lot. Yeah. If it ain't 500x leverage, I don't want it. Yep. So SPY didn't really give us any of that bounce. 3 minutes to go into the close. Filled the gap down from July. And here we are. So we're sitting on this 378. Pretty much hit that level and we got about a $1.50 bounce or so, but not enough to hit 380 again. So it's just been steady pressure here this afternoon. How much more do we see overnight? If I had to guess, based on how weak this close looks, we're probably going to gap down. I'm guessing. Doesn't look like a good candle right there. Doesn't look like a great candle. What else? Oh yeah, I want to mention this too. So in terms of the PPSI, the hurricane stock ideas, we got something pretty bad coming down the road. late next week. There's going to be no media coverage here, I don't think, until the end of this week. Well, I guess maybe this weekend. It hasn't formed yet. It's just essentially north of South America. And once that gets essentially in line with Jamaica, then it starts to maybe form, and then we'll have a lot more better data on the track. But there looks like there's something coming, and it doesn't look like it's going to be nice in the Gulf late next week and into next weekend. And what I mean by that is if I kind of bring us out to that time, what do we got right here? We got a hurricane in the Gulf. This is next Thursday. So threatening land, by next weekend probably is the time frame. Just so something to keep in mind for those hurricane stocks. We got something coming next week. So we'll see. My plan is this week, and IWM has to hold 175. If it does not on a daily candle, which it hasn't broken below it yet, if it does not, I'm going to take the TNA, the money that I had in TNA. I'm going to take that cash, roll it into PPSI, POLA before the end of the week. And then ideally we get the move next week on those guys. And if it happens, great, take that. Then I'll have some extra cash to be able to look and reconsider the market based on where we're at and where we're at maybe, a week and a half from now. And if I want to buy some other stuff, reposition into this, that, let's see, that's what I want to look at. So that's the plan, at least for me. But yeah, we're dumping off sub 380 now on SPY, 378, sub 378. We're flushing into the end of the day. You go back to SPY. Wild ride for sure, right? But now we're at those new lows. We're hitting new lows as we speak. This doesn't bode well, I would imagine, for the overnight. If I had to guess, we'd probably gap down. How much? I don't know. Are we going to gap down? How much? But with that said, surprisingly, the 10-year is not ripping. So you're kind of seeing yields. They popped, pulled back a little bit. Let's see if we get any continuation on any of that stuff. But I don't know how much this looks like it's setting up for. Well, there it is. There's your down 1.75 on the day, roughly on SPY here. 377.39 is what we're getting at as a close on SPY. QQQ closed down about 1.8. IWM closed down about 1.5%. Believe it or not, NVIDIA finished the day green. That candle doesn't look good, but it finished the day green, believe it or not. So wild ride to get to where we are, but here we are. XBI, by the way, look at this. XBI's daily chart into that box. So XBI now coming down sub $80. Finally, I guess, if you think about it, finally has come back. But we'll see if we get any divergence between between yields and the stock market, which I think the 10-year is hinting at something, but it has to really confirm down below 350 this to finish off the week for me to really take anything away from that. So we shall see. New lows. I think that everyone is in the agreement that we're probably going to new lows. I'd be curious to see where this shakes out by end of this week. 5-day average of the put call ratio pulled back today, I guess, but I wonder how. Well, let's check on the put call ratio here. Didn't spike that much. It's up over 1, obviously, but it didn't spike that much. So it's, to be honest, I guess the 5-day average, somewhere in between there, unless it spikes harder tomorrow, But with that said, I am going to wrap things up. I appreciate you guys for tuning in like always. What's today? Today is Wednesday. I'll do it live tomorrow because I won't be here on Friday. I'll be away on Friday. But we'll do live tomorrow afternoon for Power Hour. That's the plan. And with that said, I will see you guys then. And this is, let's let it shake out. I think let's see how the week finishes. And then once the week finishes up, we're going to get a better feel for, continuation moves. Because again, today's action was nuts. Obviously, we flushed lower. We could gain it all back tomorrow, or we could dump to, new lows. A lot could change in a day. So with that said, thanks so much for watching, guys. I will see you in the next one. Peace out.